So welcome to this, one of the very last sessions of the Civil Society Forum of this fall's meetings. My name is Deborah James, and I'm the Director of the International Program at the Center for Economic and Policy Research. We are a DC-based Washington think tank that focuses on providing research and policy about the most important issues of people's lives, both domestic issues as well as international. And quite a bit of our international work over the last many years has focused on the IMF and its policy implications, particularly for developing countries around the world. So we're very happy to continue what is one in, it seems like a series at this point, of discussions actually with the IMF about current policies and their implications, particularly in the crisis period. So today we will be talking about the issues as weaknesses appear in the global economic recovery. There's increasing debate over whether governments should continue or in some cases even increase stimulus spending or begin reducing their deficits and public debt. This session will look at this issue in the context of current policy, both in developed and developing countries, taking into account the different circumstances such as current levels of public debt and deficit, and the strength or weaknesses of the economy. The basic question will be, is macroeconomic policy worldwide generally moving in the right direction? So we are very happy to have here today Petya Koeva Brooks, who is the Division Chief of the World Economic Studies Division at the International Monetary Fund. And we also have Mark Weisbrot, who is the Co-Director, an economist at the Center for Economic and Policy Research. And we're going to go ahead and start. Thank you.
Thank you very much, Deborah. Thank you, Mark. Perhaps I could start by telling you a little bit about what we do and what we do in my division and also in the research department, and then move on to the topic which we have for the day. I come from the research department and its wing, which deals with multilateral surveillance. As you know, the fund conducts bilateral surveillance with all of its member countries. But in addition to that, we also have the responsibility of looking after multilateral surveillance. And in that context, one of our flagship publications is the World Economic Outlook. And my division produces that outlook, just so that you may have seen this. It's basically this book. But why am I bringing this up? Because we have this occasion every time when we look at the forecast and we look at developments across the world. We also have the opportunity to examine the type of policy economy has come out of its very deep downturn. And things are proceeding pretty much as we had expected, which is, they're not, the recovery that we're seeing is actually still very fragile, and it is very uneven one. And we see this if we just look at the advanced economies and also some emerging and developing countries who experienced sharp, very deep financial crises. These economies are coming out of the recession at a very sluggish pace. And at the same time, we see a lot of emerging and developing economies where the recovery, the rebound is actually quite robust and is going at pretty good rates. Now, the question is, where do we go from here? And can this sort of pattern which we're observing now go on? And what are the type of risks which we see? And I think the important thing to keep in mind is the following. In a way, what we really need to happen is, at a global level, is that we've seen that the recovery so far in both advanced and emerging economies, to a large extent, has been driven by the very large and very substantial policy stimulus that governments across the world have provided over the past year and a half. And that has really increased the importance of public demand in driving the recovery. That, together with the turning of the inventory cycle, really what's been driving growth in a lot of the advanced economies over the recent quarters. But this sort of thing comes to an end. And then the question is, what comes next? So what we need to see is rebalancing from activity which is dependent on public demand to economic activity which is based on private demand. And in a way, the type of cycle that you want to see is to have this initial stimulus, to have the inventory adjustment, and all of this over time to translate into higher investment as firms start to increase their capacity. What you want to see afterwards is that higher investment translates into more jobs, higher employment growth. And then the step after that is that you want to see that those jobs translate into higher consumption by individuals. And this cycle, the one that I just mentioned, in many ways has gone quite well in many emerging markets. I mean, if you think of Brazil, for example, or if you think of some of the economies in Asia, we've seen kind of the whole pattern. We've seen the higher investment, we've seen the higher consumption. But we've not seen this in many, not most advanced economies, especially the large ones. Kind of the part which is getting a little bit stuck is the investment. I mean, we've seen the increase, but perhaps we should have expected even bigger increase at this stage. And what we have not seen is that all of this makes a difference. We've not seen a big difference in terms of the job market. Unemployment rates remain very high in many advanced economies. And therefore, the type of consumption that we've seen in many of these economies has been, to a large extent, boosted by these temporary stimulus measures rather than being entrenched. And this is a process that we want to see to be completed. So this is what we call the internal rebalancing. Then there is another aspect of this, which again is important for the whole global economy, which is the external rebalancing. We know that prior to the crisis, there were quite a few countries where consumers overborrowed, they overspent, they had very large current account surpluses, and on the other hand, you had other countries, especially some in Asia, but also in Europe, if you think about Germany, for example, that had very large current account surpluses. So going forward, of course, with the crisis, these kind of got compressed a bit, but they're still quite large. And the question is, what should we expect going forward? If the advanced economies, the ones who suffered a lot of these banking crises, are not going to have the demand or the type of demand that they had in the past, which is, by the way, what we show in the analytical chapters in this World Economic Outlook, then the prospects for high growth on a sustained basis in a lot of the emerging economies that depended on exports to drive their growth is not going to be there either. So this really puts on the table a whole set of different issues in terms of what type of policies, macroeconomic policies, but also structural policies are needed to facilitate that rebalancing process. So this basically brings me to perhaps the main message that we have, is that both rebalancing acts are proceeding very slowly. And if they keep doing if policies keep doing what they're doing now, we are going to keep seeing a recovery that is sluggish, that is fragile, and that is unbalanced. So what we need is, in a way, adjustment in policies. We need stronger policies to give us this stronger growth. Excuse me. Now, what do we have in mind here? Help achieve this internal rebalancing. First one is monetary policy, and I would say this is actually the one policy that has perhaps done the most, or has reached its limits the most among the whole set of options. Central banks in advanced economies and also in many emerging economies had lowered interest rates. In advanced economies, they're close to zero. They've also used quantitative measures to stimulate activity even more. And in some cases, there are questions about whether there are limits to this. We think that these accommodative policies should stay in place, and it's very important that they are there in the foreseeable future, especially in advanced economies that are also facing the need for large fiscal adjustments. And we also see room, if needed, to do further quantitative measures. But here, we should just be realistic about what such measures could achieve. If we look at long-term interest rates across the world, especially in many advanced economies, they're already at very low levels, including for large firms. Slightly different story for small and medium-term enterprises, but in principle, if you just look at the numbers, you will see that there may not be that much there may not be that much room to lower interest rates further. So again, the bottom line here, we should just be realistic about what this could achieve. The second policy, and normally maybe 3-4 years ago, I wouldn't be talking about financial sector policies as the macroeconomic policy. But I think what we've learned from this crisis is that financial sector is just so critical, and these financial macro linkages is so important that actually I would put the financial sector policy as economies, they're close to zero. They've also used quantitative measures to stimulate activity even more. And in some cases, there are questions about whether there are limits to this. We think that accommodative policies should stay in place, and it's very important that they are there in the foreseeable future, especially in advanced economies that are also facing the need for large fiscal adjustments. And we also see room, if needed, to do further quantitative measures. But here, we should just be realistic about what such measures could achieve. If we look at long-term interest rates across the world, especially in many advanced economies, they're already at very low levels, including for large firms. Slightly different story for small and medium-term enterprises, but in principle, if you just look at the numbers, you will see that there may not be that much there may not be that much room to lower interest rates further. So again, the bottom line here, we should just be realistic about what this could achieve. The second policy, and normally maybe 3-4 years ago, I wouldn't be talking about financial sector policies as the macroeconomic policy. But I think what we've learned from this crisis is that financial sector is just so critical, and these financial macro linkages is so important that actually I would put the financial sector policy as important as monetary policy in terms of supporting this transition from publicly driven demand to privately driven demand. And why is that? I mean, we've seen that now a lot of banks have been recapitalized. We've seen a lot of injections in financial systems across the world. But we do know that the restructuring process has been going at a painfully slow rate. And in many economies, they're still weak banks, they're undercapitalized banks, and what this is affecting is credit growth, perhaps not at a generalized level, but it is affecting credit supply for certain segments of the economy. And the one that comes to mind immediately is small and medium-term enterprises. And these are usually the enterprises, at least in the US, that provide a lot of at the margin, are responsible for a big chunk of the employment growth. So getting credit to flow, to be available to these enterprises, we think is very important. Now, in Europe, we also see a lot of, we see pockets of banks and various institutions which also face problems. And those issues came to the forefront in past months. Now, there are steps taken to resolve them, but I think, the general feeling here is that one can do a lot more to actually resolve the issues and to get, again, the recovery going. Then in the financial sector area, also another aspect is this uncertainty about regulatory reform. There have been various proposals on the table. There have been some steps taken in this direction to increase capital and liquidity buffers. But the residual uncertainty that is there about the timing and the precise parameters of this is also something that, if resolved, I think is going to help this rebalancing act that I was talking about. And this all brings me to fiscal policy, and I'm going to spend a bit more time talking about fiscal policy. The thing that's really missing, and the thing that we think is the most important one, is to have credible medium-term plans to establish fiscal sustainability, especially in advanced countries. What we've seen as a result of the crisis is that debt levels have reached extremely high levels in advanced economies. And the stimulus which was provided over the past year at a global level, something that we at the IMF called for, this global stimulus to basically prevent the global economy from going into a depression-like scenario, is actually can explain only a very small part of this increase in the debt level at the global level. The main responsibility for this is very simple. It's just the collapse of output in advanced economies, which we saw as a result of the crisis. And in many cases, there were also asset price booms that were accompanying the period prior to the crisis. And when asset prices are now at a lower level, what this means is that their revenues, which were there in the past, and they're not going to be there in the future. And again, this is another reason why debt is so much higher. So now we're in this difficult situation where you have to solve a problem which is there. I mean, when we also think about the age-related spending, which is coming up in a lot of the advanced economies, the challenge becomes really, really daunting. So the question is, what do you do about this? When in the short run, you have a recovery which is fragile, which is not completely well established, and on the other hand, you have this need to adjust your fiscal balances over the medium to long run. So we think that the solution in general, and there are always exceptions here, and I'm going to talk about those as well. The general solution is that it's important to just explain to markets and explain to people how you're going to get this deficit, how you're going to get the deficits, and how you're going to get these high levels of debt to a sustainable level over the medium run. And various things can be helpful there. One is to have medium-term frameworks where you have some sort of commitment and some sort of plan, not only about a year or two, over 3 years, over 5 years, and explain exactly how you're going to do that. And the other, what could also be helpful is to have fiscal institutions, independent fiscal institutions that increase the credibility of the forecasts and kind of give this medium-term framework a bigger, make it more believable to markets and to people. But perhaps most importantly, we think what's really important is to address these longer-term issues, which are in many cases are entitlement programs, and also health-related spending, which is projected to increase tremendously over the next 20, 30 years. And just as an example of the entitlement reform that we have in mind, the important thing here is to do something that is not going to hurt growth in the short run. And one example is to link the statutory retirement age with life expectancy. This is something that can be phased in. You don't have to do it right away. But if you announce that, in 5 years' time or in in 7 years' time, the retirement age is going to be increased or is going to be linked to life expectancy. This is going to definitely solve some of the medium and long-term problems which you have as a country. So that all of this said, we still think that at exactly what pace you proceed with the fiscal consolidation will depend very much on country-specific circumstances and the type of credibility which you already have or you don't have. So there are definitely cases where you just don't have a choice. You're already facing market pressures. And markets are demanding, interest rates, the type of interest rates which you're seeing on your government bonds have risen tremendously, or they're very high. And we've seen a number of examples of this in Europe, for example. If you think of Greece or Ireland or Portugal or Spain and such. And in those cases, basically the only option is what countries did, which is to do a front-loaded fiscal adjustment to kind of put a down payment on this promise of a fiscal adjustment over the medium run. But for other countries that are not facing market pressures, and actually the bulk of the advanced economies are in this group, they still have relatively low long-term interest rates. Yes, some of them have high levels of debt, and yes, they have issues that have to be resolved. But in this case, the fiscal consolidation can proceed at a more measured pace. And we do think that fiscal consolidation should start in 2011 under our baseline scenario. And when I say baseline scenario, I mean the type of growth projections which we have right now for these economies. By the way, for advanced economies as a group, this year we have growth of 2.7, and for 2011 the projection is 2.2. So, and indeed, this is pretty much what countries are doing for the most part. Now, there is an important caveat, though. You may have seen in the other analytical chapter which we had in this World Economic Outlook actually looks at the experience of past fiscal consolidations on short-term growth. And what it finds is that pretty much what we remember from our Econ 101 class, that well, basically in the short run the effect is negative. And 1% reduction in the deficit brings domestic demand lower, makes domestic demand lower by about 1. And the impact on growth is a bit small, it's about 0.5, and this is because net exports kind of offset some of this effect. But the other analysis in this chapter, which I think is important to keep in mind, is that the current situation that we have now, in a way, is quite different from what we've seen in the past. There are two main differences. One is that that monetary policy in many of these advanced economies is already near zero. So its ability to accommodate this fiscal contraction is perhaps more limited than it was in the past. And then the second aspect is that now we're in a situation where a lot of countries are faced with the same problem, and they all have to consolidate at the same time, which again, not everybody can rely on net exports to kind of help this, to offset this impact on growth. And as a result, the type of effects that you could see could actually be larger than what we've seen in the sample. Now, on the encouraging part, the type of reforms that I was talking about earlier in terms of the more growth-friendly reforms, in terms of trying to cut entitlement spending, these are not things that had been done in the past. So those sorts of policies could offset and mitigate the impact on growth. But the bottom line of all of this is that I just wanted to convey that there is a appreciable degree of uncertainty about the short-term impact of the fiscal consolidation on growth. And because of that, and because of the general uncertainty that we live with, we think that if the growth turns out to be appreciably lower than what we have in our current forecasts, then the type of fiscal consolidation that is planned right now could be slowed down. And at the very least, countries could let automatic stabilizers work. And in some countries that have small automatic stabilizers, some of the unemployment benefits could be extended. And more generally, if growth is really under threat, then the pace of fiscal consolidation should be slowed down. So this is the bulk of our advice on fiscal policy. Now I can see that I'm running out of time, but I do want to mention the type of policies that are needed for the external imbalancing, because I think they're as important as the internal imbalancing that I was talking about. And there things become even more difficult because there's really no one-size-fits-all in terms of the policy recommendations. So the problem is, as I said before, is that a lot of this demand from advanced economies that was there in the past is not going to be there in the future. So for these economies, emerging economies that relied on export-led growth, well, they may face quite a few problems. So one solution is to shift the pattern of growth towards towards domestic sources. And indeed, a lot of countries, emerging economies, have already done so. If we look at China, for example, we have seen this shift, although it's proceeding slowly, over the past year and a half. We've seen that pattern also in a lot of in India, in Indonesia. We've seen it also in many Latin American economies. But what is really needed here is more of a medium-term shift towards domestic-led growth. And especially in economies where the exchange rate is undervalued at the current levels, we do see a role for increased exchange rate flexibility to help to facilitate that the transition towards domestic-led growth. And in many ways, capital flows that are going to emerging economies are facilitating this external imbalancing. They're going there because these emerging economies are growing at much higher rates than advanced economies. Of course, they're also going there because of the interest rate differential which these economies have. So what's really important for emerging economies is not to resist this rebalancing through excessive reserve accumulation. I mean, we've seen now reserves at a much higher level than they were prior to the crisis, which is quite remarkable. But indeed, to make this, again, a sustainable process, of course, what is very, very important is structural policies. A lot of these changes will not happen overnight. And in many emerging markets, especially in Asia, I'm thinking of China here, increasing safety nets and decreasing the incentives for people to save and increasing the incentives to consume can go a long way in terms of solving the problems. So that's in a nutshell. Of course, there's a lot more we can talk about global policies, but global macroeconomic policies. But what I want you to take away from my talk is that these rebalancing process are proceeding very slowly. And if they don't speed up, and if we don't have the policies, the underlying macroeconomic and structural policies to make this better, we're going to be in for a long haul of again, a fragile recovery with frequent bumps on the road, and also this sort of unbalanced growth which we're seeing right now. Thank you.
Thank you.